Hello and welcome to another episode of the Investing with IBD podcast. It's Justin Nielsen, your host, and it is Wednesday coming to you live at 5 as we typically do. It's May 13th, 2026. It's my sister's birthday, so happy birthday, sis. Yeah, I'm not even going to give you her age, but she's out in Vegas watching a No Doubt concert. But here I am. I'm having a good time, maybe even a better time. I got two young guns. That's what's the references happening in the comments on YouTube here. Ted Zhang and Connor Bates, both from Revere Asset Management. They work closely with Don Vandervoort, who has been on the show a number of times. Great to see you guys.
Thank you for having us on, Justin. Happy to be
Absolutely. And I think we're working on oh, there he is. Connor's there too. Awesome.
There he is.
So yeah, great having you guys on again. As I said, a lot of folks referring to you as the young guns. So before we get started, again, yeah, you guys are on the younger side, but you actually have quite a bit of responsibility. You're portfolio managers, associate portfolio managers. You're running money, making decisions. So let's start with maybe how you got into this whole game. Let's start with you, Connor. What's your origin story here?
Yeah, so really, the way that I got interested in the markets was I remember it was in high school. It was like my economics class, and it was a stock market simulator class. And like that is
Perfect.
like the start of when I got really into the market. And then, fast forward, COVID hit. I had a lot more time on my hands. I got sent home from college, and that's really when I picked it up quite a bit and dove, right into it. How to Make Money in Stocks was luckily that was like one of the first books that I read on the markets, and I look back and I'm super thankful for that because that's I think that's the best book out there to learn how to trade. And I read that book, and then it was just a couple years of trial and error throughout college, and then at the time there wasn't like a ton of educational stuff out there. Twitter was big, so that was like one of the few ways to meet people and kind of learn how to trade. And then so I was on there posting my ideas, learning from other people. And in college, that's eventually what kind of led me to get in touch with Revere. And it was senior year. I was interning with Ted at Revere. And then, once we graduated, started full time, started running some like in-house money. Dan and Don, carved out a portion of money to do like a tracker portfolio, traded that for a couple of months, did well. And then, recently about, we launched TurboTection, which Ted and I co-manage, and that's now grown to, over 40 million and growing still. And it's been a great experience so far.
That's awesome. And Ted, what about you? How did you get involved with the market? What caught your attention about it?
So parts of Connor's story that left out, our, I guess, origin stories were pretty much in parallel. And going back a little bit further, we actually first met each other playing soccer at a boarding school in Minnesota.
Okay.
In the Dev Lab
In Minnesota.
Academy.
Okay.
Yeah, so then eventually I left and we didn't talk for like 3-4 years. But similar to Connor, when COVID crashed, we were like all sent home for spring break, and I just had a lot of time on my hands. And that's where we kind of reconnected again with a third friend of ours who doesn't trade anymore, but that's where we dove into the markets. And before we found How to Make Money in Stocks, our edge was kind of in SPACs. We kind of saw a pattern in the SPAC life cycle that a SPAC would run up into its definitive agreement, and then it would sell off and then eventually make another run into the shareholder vote. So we kind of have this like no risk management, didn't really know position sizing, but intuitively we accumulated SPACs around like the $10 net asset value. And so that gave us some asymmetry there, and we were able to catch some nice moves. But eventually when that ended,
and I'm guessing
like
that was probably around 2021.
Yeah, that was 2020 into early 2021. And then
that was like the year of the SPAC was 2021. It seemed like everything that came out was a SPAC.
We were specialists. That was our edge, only edge. And that's all we traded.
Yeah. So
but
edge.
It sounds like it did kind of, eventually maybe give you the sense of, oh yeah, we do need some risk management rules here.
Definitely. Right. That all ended abruptly February 2021. And from there, I think, so I was a bio major, so then I kind of had to take a hiatus because I was studying for the dental admissions test that summer in between sophomore junior year. And I think Connor went on to find how to make money in stocks, and eventually he recommended it to me when
Shared it
we were
with you.
both juniors fall. And that was after my test, so I picked up that book, and that led me to Jesse Livermore's books, Minervini's books, Stan Weinstein, and the Market Wizard series, and all those other books. So that was our
Awesome.
start kind of there. Like Connor
Yeah,
said,
well,
we were just posting on Twitter, and eventually we
right.
both built a following. And so this is where our stories kind of run in parallel now, very similar kind of
With the
stair
internship
steps.
and
Yeah, so we DM like 30, 40 portfolio managers on our Twitter account / cold emailed, and some didn't respond, some said they didn't have positions, and eventually we found George, I think you guys have had him on IBD Live. I can't
Kachuk.
pronounce the last name. Yeah, Kachuk.
Yeah.
Yeah.
And
Okay.
he referred us both to Don because Don tweeted we're looking to hire some people, and eventually one thing another, we both landed at Revere for our senior year for our internships, and then eventually full time.
Yeah.
What Connor missed.
And I just want to mention that, I mean, both of you are doing an aftermarket kind of wrap up. You kind of share along with Don and the other folks at Revere Asset Management. And I just want to
Yeah.
applaud you at your approach, because one of the things that I like about your video, and for those that haven't seen it, I definitely recommend going to Revere Asset Management. Just look them up on YouTube and watching the videos, because I like your approach in that it's kind of uniform. It's like you almost can go to the minute of, oh, this is where they're going to cover this. This is where we're going to cover this, and so on. In fact, in the YouTube comments, one of the folks that said that he really appreciated something that he got from you specifically, Ted, was the idea of uniformity. He said this was an idea that he learned from you in one of your talks, and it's always stuck in his mind, and it's made a big difference for him. So yeah, let's kind of get into that a little bit, because again, as I watch your videos, a few things that kind of stick out. You're always talking about a few of your lists, because it's a good gauge of not just to look at the market indexes, but a little under the hood, what the leaders are doing. And there's a few lists that you guys have that you go through every time, on your videos. So there's the 21 over 21, the Turbo 12, which kind of sounds like something from a Terminator movie. So you'll have to tell us about that. And then the RG8. What are those lists, and
Yeah.
how do you decide what gets into them?
So at the start of our videos, we always have the trend gauge. I'll kind of start with this. And
Yeah.
there's 4 different sections. Number 1 is leaders. And we're grading leaders based on what the action of the stocks in the 21 over 21 list and Turbo 12 list. And so 21 over 21 list, we make this every weekend, and basically it's 21 different stocks that are trading above the 21-day moving average, and then we include a broad variety of industry groups, because like right now we could put 21 semiconductors in there, but that wouldn't give us a good view on the overall market. And so and this list comprises of names that we own in portfolios, and then names that we're actively looking to buy. And so really, at the end of the day, you have the composite performance from that list, and it looking at that list can just give you a good view on the market. How is the market today? What did the leaders do? And really, we're looking at this list all day, and it just gives us a good view on the health of the leaders. And then the Turbo 12 list is same premise, but the one thing with Turbo 12 list is we have some lesser liquidity names, so names that trade 60 million or more, whereas 21 over 21 is 100 million or about over 100 million daily dollar volume plus. And Turbo 12 is just more high beta names that we can buy in TurboTax portfolio as well, because we're just over 40 million AUM versus Grotection is over 400 million AUM. And so it's good. You can track the higher beta names. They're more volatile, but again, same premise, gives a good view on the health of the leaders and what we're looking to buy.
Yeah, I like the idea of going with different industry groups, but one of the, I guess, challenges of this market is you can choose something in the electronics and in the building, heavy construction, semiconductor, computer, hardware peripherals, and they're all AI, right?
Right.
So they're going to be
Right.
very highly correlated. So are you also looking at kind of the correlation between your choices? How do you handle that, Ted?
So yeah, that definitely is that's definitely an interesting thing you brought up. Most of our stocks are, even though they're in different industry groups, a lot of it is tied to AI. So we're not just
That's what's
putting in a
working right
lagger.
now.
Yeah, we're not
That's
putting in
right.
like a lagger. For example, having a Chinese stock in there like Baba. Well, Chinese stocks are turning around here, but it's not like we're having Baba in our 21 over 21 list for
Yeah.
the last few months, or having some random staples name in there just because to have some diversification, or including bonds in our 21 over 21 list just for diversification.
Yeah.
So even though we are picking over 10 industry groups in our 21 of 21, like you said, they're probably mostly all correlated. And we always like to say at Revere, even during corrections, bear markets, almost all stocks correlate to one anyways, even if you're a little bit diversified.
Yeah.
So
Mhm.
And I will actually say it's on both sides. In some very good markets too, you'll find that the correlation goes way up. Now again, sometimes it doesn't exactly track because again, you got the oil and gas stocks that might be moving different from the tech. But I absolutely agree with you. I can't remember in 2008. I actually got a calculation of what the correlation was, and it was incredibly high. It was
Right.
amazing.
Like,
So then, yeah, go ahead, Connor.
no, just saying, like, for right now, for example, like, if it holds, like, we'd look to add, maybe a gold miner, silver miner, copper name into the list because, they're starting to show relative strength right now and it's diversified versus tech.
Yeah, no, but it does bring up again. It's I think if you can handle it, the high concentration, portfolio can really, or high correlation, it can really kind of give you a benefit because again, when it's working, it really works. But you have to be aware of that downside. A day like DeepSeek, a couple of years ago, where AI just got clobbered. And again, it didn't matter what group you were in. If it was correlated to AI, you got hit.
Right.
So you have to be aware of the risk. And again, another thing I really appreciate every time Don is on is the way he approaches risk. Very just methodical, formulaic, if you will. So talk a little bit about your risk measures, how you know when you're kind of out there on the ledge. The rebar. Talk about that a little.
Yeah, so Rebar stands for Revere Estimated Balance at Risk, and we include this in the video every night. But basically, once the market closes every day, you take the closing values of your stocks and you adjust the stop losses for every position in the portfolio. And again, it could be a layered too. You could be selling half at 50, another half if it hits 45, but you put in all your stops and you see your estimated balance at risk. So if every stop was to get hit tomorrow, what would be the max downside of the portfolio? And again, for the outlier events like DeepSeek, where you get the overshoots, right? It does overshoot. And that's actually something that we are working on adding like into the formula to kind of try to factor in for those overshoots that happen, every so often. But again, those are just black swans. You can't really prepare for it. But what the rebar does is you're not going to scramble during the day, because lately we've had a couple days where, like we were talking beforehand, Justin, 9:45, you could have a stock down 10%. By 3:30, it's up 5%. And so and this causes people to panic because they're looking at the open P&L swing back and forth. But if you're going into the day with a plan, with your stop set, your worst case scenario that could happen, and kind of helps you stay more grounded and centered. And so that helps. Then another thing with it is that it helps when that rebar gets very, very high. That's really kind of the market telling you that your stocks are getting very extended, and it probably would be prudent to sell some and trim into strength, because again, it's open profit. So and we've seen that over tracking it over a couple years. When it starts to get very high, typically the market is going to have a pullback day soon. So it's very, very important for a process.
Yeah, and I love again because it's so formulaic. It's like it does take a little bit of that emotional component out of there. It prepares you in some ways. So if you do take one of those hits, you can be like, oh yeah, this, we kind of knew this going in to
Right.
expect something like this.
Yep.
But also on the other side, it, kind of lets you know, okay, yeah, this is, you're just a little bit more prepared for it. So
Right.
to
Because
that
every
end,
day, because when you head
yeah,
into every day, you already have your balance at risk number. And if you're not okay
exactly.
with that, if you're uncomfortable with that, then you better head into today with the plan
Yeah.
to trim
Yeah.
extended stocks or even cut exposure. And what
And
Connor
I love
said,
that
yeah.
Connor
Mm,
already kind of prepped us for this, because the next question leads to, okay, so especially in a market like this, it's so easy to be not thinking about the downside risk. It's so easy to think about, oh, if I just have another day like, like today, like, or on Monday. Monday was a fabulous day. Tons of stocks up 10% or more. And you're just like, oh, if I just have a few more of these days, how much money will I have? But the fact that you have that rebar number, you're really kind of looking at what would a down day look like. So in the morning, if you do take those hits like we've seen recently, Ted, how do you kind of handle it? How much room do you give your stops? How much time do you wait until you start taking action? And the other side is, how do you take some of that pressure off yourself with the offensive selling?
It so depends. If it's a newly initiated position, if it hits our stop, we're out, right? But if it's a
Yeah.
stock that's in profit, we're always trying to wait for the close of the day and not panic because we have our stops. We're usually trailing moving averages, whether it's the 8 EMA, 21 EMA, or oftentimes even a smaller piece worth the 50-day or 10-week. And it's always by a closing basis for us. And that allows us to not panic. Obviously, if you have the exogenous event and the stock's down 30% back to your break even, something like that, then we might just cut it, ask questions later, and then we can
Yeah.
always re-enter the stock if everything shapes up again. But like you said, just treat every stock on a stock by stock basis based on its own merits. Oftentimes, I mean, I'm sure all of us earlier in our careers, you just panic sell everything. You're like, I'm done. Like my account's down whatever
I can't
percent,
handle it.
and I'm just gonna sell everything, go to cash, and then reevaluate. But oftentimes you'll find that the next day stocks are recovering and then you're sitting there 100% cash, just wondering why you did that. So stock by
Yeah.
stock basis by its own merits. Again, since we have a plan, we came into the day with our predetermined stops or trailing stops, and we know a balance at risk, then we're comfortable sitting through some volatility.
Now, some of these names they're getting up there in terms of the ATR, the average true range.
Yep.
So meaning that they move around quite a bit. So Connor, when you're setting stops, as you guys mentioned, a lot of them are based on moving averages, the 8 EMA, the 21 EMA. But with some of these, especially when they're so extended, like the 21 EMA can be really far away. It can be like,
Exactly.
so what do you do in that case?
Yeah, it like you said, it depends on the nature of the stock and the ATR of the stock. But to your point, yeah, holding a stock like AOI to the 50-day, I mean, that could be 40%, pullback. So I think what it comes down to is number one, like what are you willing to give back on the position? And, you have to, that depends on your personality. And then also like what your cushion is as well, that can allow you to sit. But when things get extended, to mitigate that, you just kind of keep selling into strength as it goes higher. And then again, you can always add back on a pullback, because, the stock's always inevitably going to pull back. You just don't know when, but trying to hold some of these names using the 50 days is very challenging.
So getting back to the offensive selling, what do you do, Ted, when you're faced with something that's sticking way up there, the move down to the 21 or whatever logical stop you could come up with, it's just too much. What kind of things do you use to say, okay, it's time to just trim a little bit? And sometimes maybe it has to do with the percentage of the portfolio. I mean, with some of these names, look, you go up 100% in a month, like some of these stocks have done, it becomes a larger percentage of your portfolio than maybe you intended. So what kind of rules do you employ for selling into strength?
One of our favorite rules for selling the strength is 10 ATRs or more above the 50-day moving average. And we can use an example. If you pull up Micron, MU,
Mm-hmm.
we bought this out of the base breakout. Well, we first started position on April 21st in the inside day, and then we added onto it on the base breakout on April 22nd. And we were just riding the EMA higher, just letting it go. Sometimes maybe we'll take some off at the 25-30% area, 3 to 5 ATRs of profit. But for this one, we were just really bullish on the theme. The numbers had triple-digit earnings and sales. It's one of those, huge fundamental stories in the AI infrastructure build-out. So we decided to let it run. But once it hit the 10 ATR mark in that May 6th, May 7th area, that's where we cut about 50% of our position, because it did grow to over 10% of our portfolio. And that's where, like you said, it gets a little bit uncomfortable with a name that's quite fast, 7.5% ATR. And with the rest of the position, we're just trailing the 8 and 21 EMA. Even though the 21 is far lower, we've reduced risk, we've taken profits, so it's going to be a profitable position regardless. And we're willing to allow some profit volatility and give back some profit to potentially catch a bigger move. If this continues to accelerate at the... Sorry?
Yeah. No, go ahead.
And then if this continues to accelerate at the 12 o'clock direction, that's when we start thinking about like the William O'Neill, IBD, Climax sell rules. So then that's when we look for percentage move above the 200, often 100, 200% plus. That gets exhaustive. It gets to 15 to 20 ATRs above the 50. You start seeing the largest daily spreads or largest daily updates since the move has started, multiple gaps in a row. And that's when we really start to maybe even blow more into strength or even completely exit the position.
And Connor, I think I was watching a video that you just recently did. Maybe it was yesterday actually, where you were kind of talking on Micron that the action yesterday was actually kind of a little bit better. The fact that if it had taken another gap up, that would have made you feel more uncomfortable. But the fact that it was down actually made you feel a little bit better that, okay, now it's letting some of those moving averages catch up a little bit and everything.
Right. Yeah. Like what we're seeing right now is a lot of these stocks have made huge moves. And to really get that climax top, you need to start stacking those exhaustion gaps. So like if it would have gapped up, the other day, that would have been the third gap up in a row. And it's kind of looking more climax. But the one thing with these is you can consolidate through price or time. And really yesterday, a lot of things pulled back hard, but closed really nice. And, that allowed the moving averages to catch up. That worked off some of the extensions. And that's kind of what we've seen. We saw it the other week as well, these sharp down moves that get bought up pretty quick. And then the market kind of falls through the next day. And it's kind of like that short flush that works out some of those extensions. And, in the chart theme that we're seeing right now is, right, semiconductors I think they're still like over 10 ATR above the 50-day moving average. But if you pull up a chart of like AHR, for example, there's so many charts in the market right now that have this exact look. And it's like the chart theme right now is like high tight flags. There's like handful of stocks that look like this right now that have had huge moves that were very extended, and now they're putting in like 1-2 week consolidations and letting the shorter term averages catch up, and they're kind of continuing higher. And with AHR, another thing about these names is to get a true blow off top, the stock has to be quite extended out of its base. So AHR, for example, it really hasn't done that much since, getting through those 2022, 2023 highs. Sure, did it run up super hard into that? Yeah, I mean, it was a triple digit move, but I mean, it's just now into all-time highs. And a lot of stocks are like that. They had years of neglect and they've had huge moves up the right side, and people get, talk about how they're so extended, which short-term basis they can be. But when you zoom out, look at the monthly and the weekly charts, I mean, a lot of these charts are truly just coming out of multi-month, multi-year bases. And, the Wall Street saying the bigger the base, the higher in space. I mean, we see that time and time and time again. So I wouldn't be too quick to call these moves, climax or parabolic tops.
And so let's talk a little bit about like going back to Micron. because the hardest thing sometimes, especially when someone is early in their careers here, is you get this mistaken idea that if you don't sell at the top, you failed, right? So if you see something that you sold go up further, how do you kind of talk yourself down from that, Ted, and tell yourself, hey, that's okay. Or on the flip side, if it comes in a little bit, and some of these can come down so quickly, you can find yourself 10% off the high in a matter of minutes sometimes. So
Right.
maybe Ted, you could talk about that idea of being okay not getting the top tick.
Well, one of my favorite quotes that I repeat to myself when I do get frustrated if something pulls in or you sell in the strength and it goes up higher is that Livermore always talks about you can't catch the first eighth or last eighth of a move. So it's kind of that
Mm-hmm.
acceptance that you're going to miss the last eighth of the move regardless of what you do. You can sell in the strength, and at that very time you sell, that is the current high, but that stock could go higher. Or you have a natural reaction that doesn't make a new high and then you get stopped under a moving average. You're still going to end up giving back part of the move. It's very rare where you're going to time the exact top. With climax moves, you can almost get the exact top, but you're never going to get the actual top. Like you might get a shooting star candle, or you have a bar where you gap up 3 times in a row and then the third one closes at the lows. That's a huge sell signal, especially if there's highest volume ever on that day and you're like 12, 18 weeks out of the base. So those are some signs you can sort of not guess the top, but indicators in price action that can lead you to potentially selling a good area. But you just never fully know that the stock is done right there. So
Mm-hmm.
it's just the acceptance that you're never going to be perfect in the markets and you don't have to be to do well.
Yeah. Yeah, that's I think the biggest thing is the reminder like in baseball, look, you get you hit a 330 and you do that long enough, you're going to be in the Hall of Fame, even though that means you're striking out, quite a lot. But also, what about those cases where something does need to be bought back? How do you kind of identify, yeah, this is something where we're going to want to buy that position back? What are the conditions that have to happen in order for that to occur?
For me, it
Well,
has to be. Oh, Connor can go.
I
I
was
should
just
I
gonna.
should have done a name there. My fault, guys.
No, that's fine. I was just gonna say mentally, it is challenging always buying something back. Just this psychology behind it is right. If you sold something at 100 and you're buying it back at 110, like, it's hard to do. But to me, if you sell something and quickly the market shows that, you are wrong, then just buy it back right away. It's not the easiest thing to do, but it's kind of the market telling you that your decision might have been wrong. You thought something was breaking down, but it wasn't. So it's a big expectation breaker. And just even if it's not full size, just to get a piece back in, because it would hurt more if you sold it, you didn't buy it back, and it, went way higher versus at least having a piece on a rebuy.
Hmm. And is that the case with stocks that are extended? Because again, let's say you sell into strength and then it keeps on going up without you, and you just can't take it anymore, and you're like, oh, I'm going to buy that back, but now it's even more extended than when I sold it. Is that ever something that you would do?
For,
Yeah, go ahead, Ted.
for me, it has to be an independent, valid entry point or
Yeah.
setup. And I'm not gonna. I don't want to buy extended because a natural pullback will just stop you out again, and you'll just get frustrated before it heads higher. So actually, we have a good example: CIFR Cipher in the neo
Hmm.
clouds and compute space. We were trying this um, April 22nd, April 23rd, just trying to get a
Hmm.
smaller piece in there. And then eventually the whole space shook out. You can look at Irene as well, Cypher, APLD.
Right.
We had all three of them. They shook us out. And we weren't able to buy them all back. But we did get a piece of Cypher back on the day of earnings. It didn't gap up big. It shook out in the morning. And then we bought it back on that big candle up. And then
Hmm.
yeah, so that's just an example of just buying it back, and that to me that's a valid entry. It was right at the 821. It was extremely tight into earnings inside day. Didn't gap up a lot. held previous highs of the day, reclaimed the AEMA, and then we bought it back right there. So
Yeah.
for me, the buyback point has to be a valid entry point. I'm not just going to chase it back higher just because I missed it and it's heading higher again.
Mm-hmm. And to the point that you guys made earlier, and I think this is worth repeating for everyone, because a lot of these high tight flags, you might be selling stuff into strength, but to your point, Ted, if it gives you a legitimate entry with a high tight flag, it goes sideways for a little bit. I think it kind of introduces a whole brand new ball game for some of these to go up even more. And it just reminds me of, again, very early in my career, watching when I first started working for Bill O'Neill, and I was seeing the sheets of what the portfolio managers were doing, and I saw how they handled Qualcomm. And so many of them sold in what looked like a climax top, but then it held this beautiful high tight flag. They were selling into the climax top, then buying it back as it came out of the high tight flag, and it went up another 100%. And it was just like in like a month. It was nuts, and they were going in with size. So those high tight flags are definitely something to be on the lookout for. And it was actually a topic of a lot of conversation on IBD Live this morning with Webby and Mark Minervini. I want to address one more thing that I notice in your videos, which is good. You typically will have a little bit of time, a little line on some of the news that's coming up, whether it's Fed minutes are coming out, CPI, PPI, retail numbers, job numbers, what have you. How much does the news, and I feel like we got a lot of it right now coming at us almost on the daily. How does that kind of influence your decision making for the portfolio, Connor?
Yeah, so I mean, for today, for example, we had the hottest PPI print since December of 2022. So inherently not really bullish, right? Like not great. And you would think
and pretty bad CPI just before that. So.
Exactly. So
a little 1-2 punch.
Right. So, we're paying attention to the news and we understand, like, if the market sells off on it, you would expect small caps to get hit the most. So, like, this morning, that's in the back of your mind that, if the market's going to sell on this bad news, small caps are going to get hit, speculative growth stocks are going to get hit, but they didn't. So, price is always going to be the most important thing. We're always paying attention to, the economic data points that are going on each week. But with anything, the reaction is always the most important thing. And, if a stock can't go down on bad news, or, a stock can't go up on good news, those to me are always the biggest tells in terms of, analyzing earnings report, or whether it be economic data, something macro related. But other than that, really, we're aware of it and we know what's going on. But at the end of the day, the only thing that matters is the price action, right? Price is the only thing that pays. So like today, there was a reason for the market to go down, but it didn't. And that's bullish to me.
Yeah, no, absolutely. Jason Shapiro, who has been on the podcast a number of times, refers to it as kind of a news failure event. You would expect the news to cause this, and it doesn't.
I learned it from him, and
yeah,
it's amazing. The best example is, the bottom in 2022. That
October.
Yeah. I mean, that's one of
9% CPI, and
right.
It got killed like you would expect, but for it to come back like it did, very incredible, and something that Jason Shapiro did cover on the podcast.
Because the market's always forward looking as well, so it could already been priced in.
Mm-hmm. Yeah. Guys, let's get into some charts. You mentioned Micron already, and AEHR. I should have mentioned that I do have a position in AEHR myself. But before we get into too many stocks, I also want to just address real quickly ETFs. You guys are running a portfolio, and so do you ever shy away from ETFs because people are like, well, they're picking you to pick stocks, right? What's your kind of feeling on ETFs as a method of getting exposure with some, I guess, diversification and to single stock risk? How do you handle that, Ted?
We actually really love ETFs. Part of our both the Growtection and Turbotection portfolios is leveraged S&P ETFs and single not single leveraged, 1x S&P ETFs to help us get some diversification. But we're not just holding in dollar cost averaging in. We are using power trends, the 8-21, 50 and 200-day moving averages to help us with trend following in those ETFs. And then for single sector ETFs, we also love those as well, because sometimes you never know which one is the leader. Often, especially with the names like uranium that are quite highly correlated, whether it's CCJ, UUUU, or the neocloud names like Cypher, Irene, APLD, HUT. And so, for example, in Grotection, Don owns WGMI just to cover the whole basket instead of buying 3 or 4 stocks. Some of those stocks, these smaller ones, do have single stock risk. They might release an offering and you get torched on that. So having that ETF does reduce some of that risk for single stocks. And sometimes you just don't know which one's the leader, so you just buy the whole basket. And WGMI acts pretty well, and it's pretty fast as well. So the purpose, though, back about the S&P 500 ETF, why we do that, the more we scale in terms of AUM, and especially just the diversification part, most of our stocks are in growth and high beta momentum. And like those days where everything's down 5 to 8%, oftentimes S&P with the being mega cap concentrated will actually be up. So it helps balance the portfolio a little bit, especially for Grotection, where most of our clients are headed into retirement or in retirement, and they just can't withstand enormous volatility. They need a smoother ride, and they can't have as much larger drawdowns. Even a 10-15% drawdown with a whole portfolio of 8 to 10% ATR growth stocks is completely normal. So that is how we smooth the volatility in our portfolios.
Yeah. And for those that didn't catch on to it, the Grotection, it's growth and protection, right? Kind of merged together. Yeah. So it's a very important component. And I always look at it as kind of providing that ballast for, a little bit smoother sailing. But yeah, Connor, jump in.
Yeah, I was just going to say that on the topic of sector leverage ETFs, like SOXL, for example, I mean, not many individual semiconductors are outperforming SOXL. I think it's up like 370% in a straight line since the bottom. And, Intel, Marvell, ARM, all the ones that have had huge moves, I doubt many of them are really outperforming SOXL. And so they're a great vehicle. You get the whole basket. DRAM's another one. That's Don owns that in Grotection as well. And I mean, this one, you get all the good memory names and you're getting the Korea names like SK Hynix and whatnot. And again, this one, it launched sub 30 and it's nearly doubled. So, and even the T triple Qs as well, I think, near 100% or just below since the market bottom. So, I mean, the ETFs, and now it seems like there's an ETF for everything. I mean, especially with the single stocks, but I mean, there's so many great sector ETFs to take advantage of, and like Ted mentioned, reduces single stock risk as well.
Yeah, no, absolutely. It's there's a lot of choices out there. It's a very different market, and again, the ETFs make it so easy, and it's incredible to me. We had Will Rind on not too long, it was a few years ago when he was with Granite Shares launching the first single stock ETFs, and you only had them in like Apple and Tesla, and then all of a sudden it was I was stunned when I saw Circle come up with a single stock ETF shortly after its IPO. It's like, what? This already has a single stock leveraged ETF.
It's like even the most high beta stocks like AOI, for example. I mean, that stock has a 2 times ETF, which is insane.
Yeah, and the inverse versions give you a way to hedge. Speaking of which, is that something you do with some of these stocks that like Micron, instead of taking the profit, would you ever consider a hedge with something like it, like with the MUD, which is the single stock bear 1x on this? Is that something hedging? Is that something you guys do, Ted?
Sometimes for Connor and I, for especially individual stocks, we'd rather just sell into strength than get too tricky with hedging, because then you hedge at the wrong spot, you cover that for a loss, then you mess up your long too. So for us, if we think a stock's extended, we'd rather just trim instead of just using a 1x ETF. That's the inverse of it. But if we do own a lot of semiconductor stocks, we have tried the SOX S hedge one time. It just keeps going up, so we just had to close it out. And like it just happens. This market is so strong. We just got blown out of that. But no, typically we don't hedge too much. We'll short in a correction or bear market though, but hedging not so much.
Yeah. And I love that. I think Don's in the YouTube comments answering questions for folks too. So it's like you've almost got support here on YouTube. So well done, Don.
That is for TurboTection though. For GrowTection, Don does hedge because we have a lot of taxable clients in there, and especially new clients that come in with legacy positions that aren't in a taxable account. They have huge unrealized gains, so we will hedge those individual stocks with the inverse ETFs. And that is where it's super helpful to have a plethora of these inverse ETFs now. Before, if they don't have options enabled, you can't hedge with options. And then options have so many variables with theta, time decay. You have to choose the right strike, the right expiration to hedge. So these inverse 1Xs are so nice to hedge those legacy positions for that specific case.
I'm going to throw some tickers at you guys. Oh, go ahead. No, finish your thought.
No, we can go. We can jump in the tickers.
Okay. So GLW, I do have a position in this myself. In addition to the memory chips, another space has been, kind of your fiber optic plays and stuff like that. So tell us about Corning.
Yeah. So this is one of the biggest positions in Turbo right now. Definitely wasn't the easiest one to sit through. So, we initially bought this one on the 7th. So kind of that, that tight area. And then you obviously got the market wide gap up. And then you had that earnings gap down right into the 50-day moving average that, wasn't the comfiest thing to sit through. But in a hot market, I always try to give it the benefit of the doubt. And even with that earnings gap down, it never violated the initial stop from the position. And we've seen that before as well. As much as we love buying earnings gaps, sometimes a gap down that puts in a hammer off a big support spot, is just as good, especially if they had good numbers, sales, earnings, whatever. And then on that upside reversal day, actually added onto the position and then got rewarded with that NVIDIA partnership news on that gap up. And now this one is, closed back above 200. Haven't trimmed any at all because this chart also looks a lot of other ones. And pattern rec doesn't show it, but this kind of looks like an ascending base to me. You can kind of draw that upper trend line that it's kind of breaking out of, if you started at that 162.10 high a little bit. And it kind of had like 2-3 pullbacks on that upper trend line, and it's just now breaking out. And this stock isn't extended at all. It hasn't really had like a multi-week clean run. It's had a couple gaps, came back in, backfilled, but now breaking that kind of upper trend line sometimes can signal that maybe this is going to be linear and really run the next couple weeks. AOI is another good example of kind of that ascending base-ish look. And actually bought this in TurboTection today as well on the undercut of 200 and reclaim. And this one kind of also has that ascending base-ish look. And if you go to the monthly chart, this goes back to my point about, yes, these stocks have had big moves, but when you zoom out, the stock is just getting back above 2016, 2017 highs. So if someone was holding from back then, they're just now in the profit. And this one just kind of, fits all the boxes. Good fundamentals, hot theme, major RS. But I do want to touch on one thing with AOI though. Position sizing is important in a name like this because a 10% position in AOI is much different than, say, a 10% position in a Lilly. So this one's obviously always going to get size smaller just due to the nature of the stock. And it would be totally normal if the stock was down 12% one day, because that's the ATR of the name. So that's another big important thing in this type of market. If you're trading some of these higher momentum, higher beta names, you know, the right position size is the position size that allows you to sit, because a big position size doesn't do you any good if you're just going to get shaken out in one little downtick. And so that's important. And I can get into this. We have the RVAB, which stands for Revere Volatility Adjusted Beta. And basically, this is scoring the stocks in the portfolio and helps drive the position size as well. Also, the stop as well, but knowing what would be the max size for a stock like AOI, because if it does have a down day, which it will, that's going to be, could be double digits, and that's going to be a lot of volatility on the portfolio.
Yeah, no, absolutely. And then Ted, one of the stocks that I hadn't looked at in a while that you brought back on my radar was Akamai, AKAM. You want to talk a little bit about this one?
So this is in the edge computing theme with DOCN, Fastly, which got destroyed by earnings. But this is the whole push to host, your models or OpenClaw or one of these agents on their servers, their cloud servers. And that's pretty much the story and narrative with this name. It gapped up on earnings. It had nice beat and raise, and really it's just a simple over that 140 level, 5-minute open range break, and I just took on the gap. If you zoom out, it made an all-time high. And I don't know if Dr. Wish has been on this podcast before, but he calls it the green line breakout, which is an all-time high breakout after 3 months, at least 3 months of consolidation. And so this has been going sideways for quite some time, and it just it looks really good to me. Market Surge has it flagged as the highest volume in this base, which just adds on to the explosive nature of the stock. And then, like always, stocks move in groups. So if you look at DOCN, that also gapped and had a huge report into all-time highs as well. So that is more confirmation that the group is working. The theme is there. This year's has been the year that AI agents started off with Claude Opus 4.5. And that brings me to the point. You talked about that news line on our videos. There's some pieces of news that are less consequential for us, but oftentimes some of the biggest moves in stocks stem from news. And in news, that for me includes earnings reports. That is probably the best types of news to start to track and even latch on some of the next biggest winners. And those are often the biggest winners when they have huge beat and raise quarters. They raise guidance. CEO talks about some inflection point, whether it's positive from negative to positive earnings, gross margins expansion, positive free cash flow for the first time. Any of these keywords that the CEO, CFO, and management talk about can spur a stock onto a multi-100% move, especially out of a neglected big weekly and monthly base. And all it takes is one piece of news to ignite an entire group and theme. So that is where we do really put high emphasis on news in that specific snenario.
Well, and like with something like this, again, you see DOCN, you see Akamai, as you mentioned, Fastly, not so much. That one got, clobbered. We saw, if I remember correctly, like a 27% drop on that day. But it was ugly. But talk to me about getting into Akamai. So there have been so many of these stocks that the earnings reaction has been incredible. Fastly on the downside, you're seeing those, but then on the upside, you get these, and it's like this piece of news comes out, or the earnings, and everyone is just like, get me into this no matter what price. How do you manage your risk on something like that? It gaps up that much. How do you get yourself in with a stop that is reasonable?
There's a few entry tactics that I use. The best gappers often flag where former base versus pre-market and post-market highs. So if you really want something, you could just buy it off the open if it breaches pre-market, post-market highs. A 1-minute opening range break, for those who don't know what that means, it's waiting for the 1-minute candle to form. Then you buy through the 1-minute highs. You can use a 5-minute opening range break, or if a stock in its history is quite choppy and it doesn't have much follow through, you can use a 10, 15, or even 30-minute opening range break. So the higher time frame you go, the higher the win rate, but you might have to size smaller because the stop to low of the day, which is where you want to place your stop for these earnings gappers, becomes wider. And the reason why you want to place a low of the day stop for earnings gappers, because that's the structural point where it confirms that you're wrong, at least at that current point. For re-entries, a retake of the gap day's low, it could be a reclaim of VWAP as well, or you wait for some sort of flag that forms the next few days and you can get back on again.
Yeah,
so and that's typically how I view the different ways to enter an earnings gap.
It's great because you have multiple things that you can do. You can maybe get part of your position on one of them. Maybe it flags for a couple days and you get to add to it. You know, sometimes you don't, and you just have a small position, and you got a piece of it, right? BE, this is another one that I own. Connor, what are you guys thinking with Bloom Energy?
Yeah, so you know exactly what Ted was talking, paying attention to news. This one, you know, we traded this a lot over the years. You know, traded it down near the 40s, and then if you go zoom into like that pullback from, you know, 147 to like 75, now that looks just like a blip, or go back a little bit. Yeah,
this
like
one
now,
right here, right?
yeah, now on that chart it just looks like a blip in the history of this stock. But that's an example of like, that's a harsh pullback, and it's hard to sit through because we had a good average down there, but inevitably we sold it as it was breaking the 50-day moving average, and it didn't really do a whole lot after that. And you know, you can just always get back into a stock. So, you know, form this base, and then the big news was the deal with Oracle when it gapped up through 200, and we just bought that gap up, you know, at around like 203 and change, and it, you know, pulled back kind of to the like the lows of that gap day, but had good volume, and then it's just been continuing higher. And to your point, to adding to winners and adding on strength, like BE looks like a pretty good high type flag to me. So, you know, perhaps if this breaks out through 300, that would be another valid add-on point as well. I mean, there were even add-on points here like near the 21 we never added. We just have that initial core from that gap up back near 200. But this is definitely on watch for a potential add, and it just highlights, to me, it's just, you look at all these stocks and, you know, you just want to focus on the strong stocks because they typically just keep getting stronger and stronger. They might go through a period of consolidation, but the story on Bloom Energy has always just been so big, and it's been a really big winner. And, you know, they're like, who knows if that's going to change anytime soon, as long as it, you know, keeps respecting certain areas.
I think we got time for one more. And Ted, I think you brought up a really good point. You were like, hey, you know, it's worth looking at losers too, right? You know, it's important that folks know, hey, they don't all turn to gold, you know, and everything. And it's so important because managing your risk, and at least I feel, and I see you guys do this all the time, you take your losses early, you know, and it's kind of like you just move on a lot of times, and it's like no harm, no foul. You take a little hit, but it's much better than sitting with something for a long time that doesn't go anywhere, or even worse, something that goes in the wrong direction. So what's a loser that you want to take a look at?
Let's talk about URA that we got stopped out recently. And what we talked about, taking losers is the most important thing in trading. Whether you're listening to myself and Connor, and we're quite young, or Jesse Livermore from 100 years ago and he's dead, it stays the same. It's all about cutting losses. It doesn't matter what investor or trader you listen to. In their system, there's a rule for cutting losses and ditching the laggards. If you don't, you're going to hold big losers, and that will destroy your fortune. So you don't want to do that. For URA, we entered, give me 1 second, let me find the date. We entered URA on May 4th. It was breaking above the inside day high. It ended up squatting on us and closing still above the 21 EMA. So we held on to that, and our stop was in the 53, and 3.5 area. And then it broke out on May 6th, and that was obviously good action. And this just has been really choppy. CCJ is a big component, quadruple U as well. It reversed back in on us, then tried to go again, then eventually gapped down below the 821, and we closed it out. just yesterday. So just a quick loser. It was a 2.5% size, 10-15 basis point loss, no harm done. But holding a loser down to, let's say, 20, that'd be a harm done to the portfolio.
Yeah.
So just cut it. You can always get back in.
Yeah, that's exactly what I was going to say. You mentioned that earlier. You can always get back in, right? This isn't a broken chart by any stretch. So yeah, you can always get back in, right, Connor?
Yeah, no. If we have time, I just want to talk about another loser, because I just feel like talking about losers is a good thing to do. There's a lot to learn. So AMPX, this is a really good example, because going into earnings, we had plenty of cushion. If we're going to hold a stock into earnings, one, you need cushion, and we calculate it versed on the implied move for earnings. So what's the implied move of the stock? What's your cushion? If the stock did 2 times the implied move, what would be the damage to the portfolio? So like, that's the checklist going into an earnings report. And AMPX, there was no reason to sell into earnings. Like the story, the stock was at the highs. We had cushion. It's a hot market. Like why would you sell it into earnings? And it gapped down 20% on earnings, and all those profits were gone. We sold it immediately, and it's came back up, but it's the market will make you look stupid all the time, but there's no saying that AMPX gap down on earnings below the 50-day moving average on high volume. Typically that is going to resolve lower. And so this is just an example of followed the plan to a T and it didn't work. And as we know, we lose more than we're right. And that's just part of the business.
Right. And then if we have a little more time, could we just bring up the opposite end? So we also had Rocket Lab before earnings, and we didn't have enough cushion either. So we got rid of the position. So for AMPX, we held the position, got nuked on earnings. But Rocket Lab, we decided to take off the position when it closed below 8.21, and it's up 40% from there. So earnings season can be tough sometimes, and just have to follow the process.
And if you're good,
process over outcome.
if you're gonna catch gap ups, like we got rewarded with a 15% gap up on GLW with that NVIDIA deal. So it's like, if you're gonna get the gap ups, you're also gonna get the gap downs, and it's just part of trading.
Yeah, no, absolutely. Well, guys, congratulations on, again, I think some of the old guys always look at the young guys, they're starting out and have such a good head on their shoulders, and there's like jealousy that you're just starting out so great, and sometimes it's that, to be young again and to have all this runway ahead of you, instead of like, I better not mess this up now because I don't have much runway. But awesome having you both on. Congratulations on your success with TurboTection. Not TurboTection.
The portfolio.
TurboTaction. Okay.
Turbo,
yeah. Okay. Okay. Yeah.
Thank you, Justin.
For a second, I thought
I know Don's in the chat, and Don took a chance on both of us, so we're both grateful to Don as well. So it's nice building Revere for the last almost 3 years now, and it's just we're just grateful to do this every day.
And for folks to follow you, Connor, what is your X handle?
Connor J Bates _.
Okay. And Ted?
Ted H Zhang _. And then our Revere Twitter is just Revere Asset, and same with YouTube.
Yeah. And again, I highly recommend taking a look at their videos. They've got some great ones there. The whole group does a great job. I've highly respected Don for a long time, and it's great that he's training the next generation. So awesome having you guys on. Thanks so much.
Yeah, thank you so much, Justin.
Thank you, Justin. Appreciate it.
It was a lot of fun.
Pleasure. Yeah. That's going to wrap it up for us. Watching. Next week, we're going to have a surprise guest. We actually had to back out at the last minute. Someone was launching a fund, and he was going through a quiet period, so he couldn't be on during his quiet period. And so we're going to be seeing what we come up with for you next week. But stay tuned. I'm sure we'll have something fun, and hope you join us for that. We're going to be live at 5 next week on the 20th. We'll see you then. Take care, everybody.